This chart tracks the Russell 1000 index from November 2021 through late January 2022. Notice this dark blue bracket right here. That is a 9.1% drop in the index, erasing billions in market cap. And it happened before the Federal Reserve executed a single rate hike for the year. For duration-sensitive strategies, the official date of a scheduled FOMC rate decision is almost never the actual catalyst for a market sell-off. The real damage is triggered by a variable known as the futures implied path factor. The path factor measures the market's continuous repricing of the expected future trajectory of rate hikes, calculated through futures contracts rather than spot rates. When the market expects a tighter trajectory, this path factor reprices rapidly, forcing cycle drawdowns in long-duration assets 40 to 60 days before the spot rate ever actually moves. We are conditioned to wait for the Federal Reserve Chair to step to the podium and announce official policy changes. But while the financial industry standardizes its risk management around these scheduled announcements, the forward curve has already telegraphed the shifting reality weeks in advance. Calibrating an institutional risk model to the calendar date of an FOMC meeting structurally guarantees that capital is maximally exposed during the exact window when the real repricing occurs. To understand why the spot rate lags, we look to a 2005 paper by Gürkaynak-Sack-Swanson. They decomposed monetas into two components. The first component is the target factor. This captures the immediate surprise in the current meeting's policy decision, a same-day event. The second component is the path factor. This isolates the anticipated future trajectory of policy, completely independent of the target rate. Their empirical finding is explicit. The path factor dictates the re-rating of long-duration assets, while the target factor has minimal effect. This image illustrates the release of the January 5, 2022 FOMC minutes. As the market parsed the document, the green CME future strip shows the implied trajectory jumps to 5 25 basis point increments. These intermeeting document releases shift hike expectations by hundreds of basis points, with zero change to the underlying spot rate. This forward pricing mechanism operates entirely outside the boundaries of classical, backward-looking rate correlation models. Parsing FOMC minutes triggers an immediate mathematical repricing of the discount rate for every duration-sensitive asset in the portfolio. Moving from academic theory to the reality of the trading floor requires specific quantitative parameters. This data overlay defines the precise actionable signal. You track the 30-day change in the implied rate embedded in the 6-month forward SOFR futures contract. The trigger threshold is crossed when this implied rate spread to the current SOFR fixing exceeds 50 basis points. However, relying solely on the raw implied rate creates an exposure gap at economic cycle peaks, requiring a risk premium correction. When macro indicators are elevated, specifically an ISM manufacturing print above 55 and a BBB Treasury spread below 200 basis points, the risk premium is compressed. You must widen the path factor estimate by 25 to 50 basis points to capture the true anticipated trajectory. Once the signal fires, portfolio liquidation faces strict execution boundaries. Duration exposure must be unwound within a narrow 5 to 10 trading day window. To execute this without moving the market against your own positions, trades must be kept between 3 to 5% of the average daily volume for each underlying name. The mathematics of these liquidity limits create a hard ceiling. They cap the strategy's full exit capacity at $3 to $5 billion in assets under management. Pushing beyond that $5 billion threshold generates market impact that invalidates the exit. At that size, the alpha signal degrades from a complete portfolio hedge into a mere gross exposure governor. The early 2022 tightening cycle provides the cleanest empirical test of this mechanism on record. This visualization maps the daily price action for ticker IWF, the iShares Russell 1000 Growth ETF, serving as the primary proxy for long-duration equity. The first critical data point lands here on November 18, 2021, establishing the pre-drawdown cycle peak. As the forward curve begins pricing a steeper rate trajectory, the price action collapses down to a pre-hike trough in late January 2022. This descent marks a severe 12% maximum monthly drawdown, fully realized before any official rate action occurred. The third data point is March 16, 2022. the day the Federal Reserve officially executed its first 25 basis point spot rate hike. The market reaction is counterintuitive. Equities actually rallied on the exact day of the hike. This perfectly illustrates the Kuttner mechanism from 2001. Policy decisions that are fully anticipated by the forward curve have near zero incremental market effect. Speculative accounts were recorded cutting their short rate bets on the eve of this rate hike, attempting to front-run a move that had concluded 6 weeks prior. The exact moment the Federal Reserve officially tightened policy was the exact moment the path factor damage had already been fully priced into the market. The standard institutional counterargument is that maintaining 2-year Treasury duration hedges provides adequate protection against rate shocks. This commercial risk factor decomposition matrix reveals the architectural flaw inside industry standard models like Barra and Axioma. The specific vulnerability lies in the model's reliance on historical Badal betback windows to generate current risk forecasts. Heading into the 2022 cycle, these models derived their calculations from a calibration dataset spanning 2012 to 2021. That decade of stable, zero-bound interest rates generated a purely decorrelated regime between growth equities and the yield curve. As a result, the model feeds portfolio managers a fatal output: a near-zero rate beta for growth equity positions on January 1, 2022. The backward-looking nature of the look-back window permanently invalidates the historical beta at the exact moment the rate equity correlation reasserts itself. The structural failure of these models to incorporate futures curve data leaves fundamental long-short funds unhedged at the start of a tightening cycle. To maintain intellectual rigor, we must define the precise conditions that would falsify this thesis. 3 specific parameters stand out. The first of these parameters is hike day concentration. If future equity drawdowns concentrate on or after the first hike date rather than before, the mechanism is misidentified. The second parameter requires clear behavioral evidence. Documentable, industry-wide convergence in pre-hike long-short strategy returns would signal that the execution edge has decayed. The third parameter is a structural model update. The release of an Axioma or Barra version natively incorporating SOFR forward rate changes would close the calibration gap. As of mid-2026, zero public evidence exists for any of these 3 invalidation parameters. The current institutional reliance on these backward-looking commercial model outputs remains a live structural vulnerability for the entire industry. Until the cross-sectional risk architecture is rewritten to include forward-looking inputs, path factor repricing remains the primary driver of unmanaged drawdown in duration-sensitive capital.